Good day, everyone. Thank you for joining us once again here at Seaford & Brew for our economic briefing. For this briefing, we want to review over the fourth quarter performance of our community bank benchmark group. If you recall, this group is made up of financial institutions between the assets of $100 million and $5 billion. And this is the group that we utilize in our performance risk report on a quarterly basis. Overall, when we look at the performance in terms of return on average assets, we see that this group declined from 123 back in the third quarter of 2019 to 111 in the fourth quarter. Now, it's not too surprising to see a decline in overall return on average assets in the fourth quarter. That tends to be a trend throughout history. But when we look at the different subgroups inside of this benchmark, we can see that the subchapter S institutions declined from a 161 in the third quarter down to a 142. The stock institutions went from a 117 down to a 106. And then we have that mutual institution group coming in at a 0.59, falling from where it was at a 0.66 in the third quarter. So overall, all three subgroups did decline in terms of return on average assets. When we start looking at why this occurred, one of the reasons was the decline in net interest margin quarter over quarter, going from a 384 down to a 375. Now notice as we look throughout the past 5 quarters, this 375 is the lowest in terms of quarterly net interest margin. The high was back in the fourth quarter of 2018 when that net interest margin reached 3.87. Looking at the components of this net interest margin, we can see the return, the yield on average assets came down quarter over quarter from a high of 4.73 down to 4.62. Interestingly, when we compare this to last year, the fourth quarter of 2018, it's the same 4.62. So while we had an increase overall throughout the year, we ended the year on a quarterly basis, the same place where we ended last year in 2018. Now, in terms of cost of funds, we saw that come down quarter over quarter by 4 basis points from 97 basis points down to 93 basis points. But year over year, we're still up 11 basis points. Now, obviously, the question is, throughout 2020, are we going to be able to stop the yield on earning assets from coming down and continue this downward trend in that cost of funds? That's going to be the bigger picture as we move through 2020. When we're looking at the overall cost of interest-bearing deposits, we can see we're at 1.15% for the fourth quarter, down from that 1.19 in the third quarter. So we see this peak and then we come back down. This is likely due to a lot of those specials in terms of CDs rolling off, those shorter CD specials, and we should continue to see this tick down little by little as we move through 2020. The bigger question is, can we move down that core deposits in terms of those non-maturity deposits down further than we have already? And that's going to be the saving grace here, is when we can continue to reduce down those core deposit rates. However, over the past year, we really haven't moved those up all that much. In terms of the cash type deposits, the total deposit ratio, we see this coming back up after hitting a trough here of that 70.57, coming back up to the 71.43. So we see this little trough occur, but overall, year over year, we did increase the overall level of cash type deposits to total deposits. And recall, cash type deposits are simply those non-maturity deposits on your books, which tend to garner a higher level of economic value. However, we've seen at many ALCO meetings that economic value has waned a little bit just because the level of interest rates has been a detrimental impact on that EVE premium that you garner from these cash type deposits. Overall loan growth, we've seen a slowing in here. This is the aggregate loan growth for this benchmark group. And you can see back in the first quarter of 2019, we're at 1.23% for the quarter, and every quarter we've stepped down a little by a little. Now this is where we come in at for the fourth quarter, down to 0.5% in terms of loan growth. And we've seen this at many institutions where this loan portfolios and the pipelines tend to roll off and are being narrowed. Also, we've seen a lot of refinancing of debt with other institutions. So we see this come down in here. This is a little worrisome, kind of matches the market in terms of GDP, and we see in the GDP the lackluster growth in that business investment. So we continue to see this come down. Hopefully we can get this to pick back up in here with the phase one of the trade agreement signed. Hopefully we can give some confidence to these business owners to start these capital projects up again. I've been at a number of meetings, ALCO meetings, and it seems like we are starting to see a revival in some of the loan portfolios here in pipelines. So hopefully we see this continue to move up rather than this downward trend that we've seen. When we look at credit risk, non-current loans, the total loans at 53 basis points, right where we've been over the past couple of quarters. But notice year over year, we're up a little bit from where we were in the fourth quarter 2018 at 0.49. When we look at net overhead, we see net overhead dropping to 2.02%, down from where we were in the third quarter at 2.10. This is a very positive trend, and this is what we like to see. We like to see institutions under 2% in terms of net overhead. Now, when we look at non-interest expense, that went up to 2.82, and non-interest income came down to 0.61. So we had this kind of widening out here. Typically, this happens in the fourth quarter, and then we start to see it trail off in the first quarter and then level out. So hopefully we can see that similar trend as we've seen in history of that coming down. But year over year on non-interest income, we are up by 3 basis points. So that's an overall positive, and we will need to continue to find new ways to bring in that non-interest income in terms of maybe offering different products or looking at your fee base and making sure that your fees are at the market, as well as you have a low level of fee waivers. On the tax side, the tax burden, very similar, continuing to be around that 20 to 21% in terms of taxes. Right now, an institution that is effective in managing their tax burden can get a tax burden of less than 16% right now. And that's what we encourage institutions to evaluate their investment portfolios and their loan credits to see if they can utilize some tax credits to reduce down your overall tax burden. But right now, on average, around that 20% in terms of taxes. When we were looking at risk, we did see a slight increase in the overall risk score quarter over quarter as well as year over year. Wasn't a significant increase, but we did see a slight increase, which we haven't seen in a couple of quarters. When we look at the overall exposure on the 4 primary areas of risk, we notice that the credit risk indicator is the one that's really pushing up the overall risk score. So we want to keep an eye on that in terms of where the credits are inside of our institutions. Make sure your underwriting has continued to be solid and that you're reevaluating those loans, those commercial loans, on an annual basis. But overall, the risk continues to be below 50 in terms of that total risk score, which is where we like to see that benchmark group. Well, that's what we have for you today. We look forward to speaking to you again in another briefing in which we will look over the interest rates and how they've changed over the past couple of weeks from the beginning of the year. Have a great day, everyone.